Hello, everyone. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, bringing you the final 11th video of our covering the 11 sectors for GICS codes by S&P. This video will cover utility stocks. And like I did with all videos, I did a screen for utility stocks, and I came up with 12 stocks that I'm going to go over at a high level. Now, utility stocks, like REITs, are best used for income investors. They're not designed to beat the S&P. They're not high growth stocks. What they are prodigious dividend producers. Most of them have good dividend growth and good consistent dividends. And thanks to interest rate changes here recently, a lot of these utilities that were overvalued have now become attractively valued. So let's look at 12 choices that you can utilize in your research. Now, once I get into the fast graphs here, I screened for the best utilities I could find, and I came up with 12 that I think are worthy of talking to you. And I've created a portfolio. I call it Utilities Income at Value. And what I'm looking for are stocks that have good valuations, okay? So that means earnings yields over 6.5%. So you can see I've got 2 or 3 or 4 here, 4 actually, that are slightly below that, but not by a long shot, just by a little bit, and that would be New Jersey Resources. But then I've got the rest of these, the other 8 are all producing earnings yields that are greater than 6.5% to 7%. Some of them have really exceptional numbers. Now, as I like to usually do, I'm going to do these in alphabetical order only because it's easy to track them. By the way, the majority of these are investment grade utilities as far as credit ratings by Standard & Poor's. They're triple B minus or better. We do have a couple. New Jersey doesn't have a credit rating. UGI doesn't have a credit rating. And Suburban Propane, which is kind of a unique utility, if you will, not really a standard utility, is only double B minus rated. So let's go ahead and utilize the Fast Graph tool, and let's get into each of these companies, starting with AES. Now, AES is an independent power producer and energy trader, but they also are kind of known for investing a large amount of money into alternative energy sources. So that's one of their fortes. Now, looking at this stock and taking price off the graph for a moment, and this is what I want to just orient those of you, again, who are new to the channel and new to Fast Graphs. This is a picture of their earnings per share, the orange line. And you can see that the orange line shows good, solid earnings historically. They did have a period of time where earnings were dropping. And by the way, that's during a period of time where they initiated a dividend. But they started, a first dividend was only 4 cents a share, and their dividend payout ratio was minuscule. But then they increased it to 16 cents a share. And they've basically grown their dividend ever since. And now they're averaging somewhere around a 40% payout ratio, 35 to 40, we'll call it. Okay, and that's the area below the white line here. And the white line is a plotting of dividends. So you can see this has been a very good dividend income generator since they started paying a dividend back in 2012. Currently, because of the valuation, which I'll illustrate in a moment, you can get just under 6%, or we'll call it 6%, 5.98 to be precise. And you can buy this stock at a PE ratio of only 6 with an earnings yield of 16.47%. So those fundamentals are very strong. Now, the company does have a lot of debt, and that's something that you would want to take a closer look at. Remember, when I do videos like this where I'm going to cover 12 stocks, I'm simply going high level. Now, one thing I do like to look at when I'm looking at dividend-paying stocks is I like to see cash flow, operating cash flow, covering the dividend. So in other words, in simple terms, this is the operating cash flow. It's higher than the dividend income, which means they've got plenty of cash flows to pay their dividends, which gives me great comfort in looking at the fact that they'll probably continue to pay and maybe even continue to grow their dividend. The real asset test is free cash flow. Now, because it's a utility and to some extent capital intensive, free cash flow is a little bit troublesome. So that could also explain why the stock has been weak, but they do have plenty of operating cash flow. Now, from an adjusted earnings point of view, it's been a pretty consistent grower at 6.48%. And I want you to notice in the last several years here, companies actually generated 7.64% growth since 2018. let's go back one more year. It's 7.87% growth since 2017. And this feature with fast graphs allows you to do some quick analysis. Now, in 2016, that was the last year where they had a drop in earnings of 20%. So once they passed that, which means 2017 beyond, they averaged about 7.87% growth. From a future point of view, analysts expect, and there are 14 analysts following the company, it drops down to 12 and only 6. So I usually like to go out about 2 years on these estimates. And remember, they are estimates, but I've got a pretty good group of analysts here, and I'm looking at decent growth for this year, which will be reported soon. Then I've got about 7.5 to 7.6% growth expected for '08. And that number has been consistently the same. It did drop a little bit. The most recent estimate, 6 months ago, it was 209. It's currently sitting at 208. The 2026 estimate is increased by a penny, so that's kind of a good thing. And if you look at their analyst scorecard, they have a very, very good scorecard. They've only had one miss on the 1 year with a 10% margin of error and a 2 year with a 20% margin of error. So analysts tend to get this company right. Now, going back to the historical graph, the point of the fast graph is that, first of all, it gives you this broad picture of what kind of company. This is a pretty good, consistently growing company that started paying a dividend in 2012. Now, earnings determine market price in the long run. Emotions determine market price in the short run. So when I put price on the graph, I can see, in essence, what I'm saying is fundamentals drive stock price. And you can see that the stock price has tracked the fundamentals of the company when during periods of weak earnings, it was pretty much undervalued. It's now currently undervalued, but there's no real weakness going on in the earnings. This might have to do with some of the issues that have been going on with alternative energy. And if you've been following that, there's been some problems there. But the stock has dropped precipitously. Now, historically, the market has valued this at around a 13 PE. And again, if I just look at the last several years, it's been a 13 PE ratio. So if the stock were to earn $2.08 in 2025, I can simply use my calculator functionality of the fast graph tool here, which helps me analyze what my potential is. And I can simply go up to the end of this year, which we got a full year ahead of us, and calculate a performance potential. And that would give me the opportunity to see doubling my money if now this is a what if scenario, if it earned $2.08 and if the market brought it back to a normal PE of 13. And of course, it would do even better if the market brought it back to a higher one. So going into forecasting again for a minute, I can just point to these different areas here. Here's a doubling of my money by 1 year. If I go out 2 years, I almost triple my money, averaging about annualized at 73% a year. This is at a 15 multiple. Okay, if I use the more conservative normal multiple of 13 times earnings, now the last 5 years it's averaged 14.65, but I can use my drop down here and I can go in and I can find a 13 PE, and the 8-year normal has been 1306, and that's a good solid conservative number, but you can see I still have the opportunity to more than double my money and even potentially triple my money over the next 2 or 3 years and earn a very high dividend yield while I'm waiting. Now, from a performance point of view, historical performance point of view, this goes back to 2017. I want you to notice that it's generated double the income that the S&P has, but it's dramatically underperformed the S&P, which is more growth oriented. It doesn't necessarily provide the income you need. And the income has also grown at an average of about 6.27% per year. Now, if I expand this out even more, go into my max time frame here, once again, we underperformed the S&P on an annualized rate of return growth basis. But once again, when we look at total dividends, we end up earning a number that's very close to the S&P. But keep in mind, that is simply because this company did not pay dividends for most of those years, and yet it still produced almost as much income. So when I look at historical, we didn't start paying dividends till 2012. So once again, I use my calculator feature here, and I move this back to 2012. This, gets me to where I'm doing. So I'm going to go my 15-year time frame here. Now this is where I'm comparing apples and apples. During the time that the company paid a dividend, it did produce more income than the S&P 500. The primary allure here for this particular company is the very low valuation and the high quality products that the company operates in. Going to number 2 is Avista Corp. Again, this is a multi-utility operating in the United States. I want you to notice that the market has really applied very high valuations as interest rates began to rise. The utilities reset their value, and now that they're cutting rates, we've got the opportunity to buy this at an attractive valuation. The orange line would be fair value of a PE of 15. In this particular utility, the market has traditionally put a premium valuation. So looking at it from a 15 PE, again, I've got a 5.28% dividend yield. Looking at it from what my opportunities are, I could be making 20% rates of return, 14% over 2 years, and 10% over 3 years, with a 5% dividend yield being the foundation of that. Again, when I go into performance, I'm going to find a utility that doesn't produce as much growth as the S&P, but I've got a lot less risk, and I've got an income of $7,660 in income on a $10,000 investment back on December of 2012 versus $4,280 in the S&P. We'll call it close to double the amount of income. This is all about income and all about the income growth. Now, this one only grew dividends by 4%, but I want you to understand what that means is. That simply means that the company's grown earnings at about 5%. If I go in the max version, it's grown earnings by about 4% per year. But again, there are some cyclicalities here. But once again, notice how the stock price tracks that. And when the price gets disconnected from the orange line, how it always moves back into alignment. And even when you get these periods of high valuation, this is a very poor time to be investing in a utility stock or any stock because, first of all, we don't grow very much here. Okay, so it's imperative that you buy it at value. But this one now is at value and offers a nice 5% rate of return. Moving on, I'm going to move a little quicker now so that hopefully you get the idea. We got Black Hills Corporation. It's offering a 4.57% yield. It had very high valuations historically back in 2011-12. Of course, COVID came and it adjusted. Then it recovered to high valuation, but now we can buy it at a 14.66 valuation. That's an earnings yield of 6.82% and a 4.57% dividend yield. Okay, now again, looking at these stocks, if I was analyzing these individually, I would look at operating cash flow. I would want to know what happened in 2011. And then I would also look at free cash flow. And with utilities, because of the capital intensive nature, you're not going to see very good free cash flow results with these utility stocks generally. Okay, so what you're really looking at here, again, is an income vehicle, but not a very high growth stock. Now, the next one is Edison International. It's one of the more famous, I guess you'd say, utility. But once again, you see growth about 4.5%. I shortened the time frame to 18 years. It's under 4%. But you can see how the price tracks earnings. We got a 5.4% dividend yield. I don't know if this is actually a dividend cut or simply an error. That would be something that you'd want to look into further. But you got 5.4% in a utility stock now that's basically trading at a fair valuation relative to its fundamentals. And again, good solid rate of return potential going forward, assuming the company earns the money that's expected here and assuming it trades at a 15. If I go to the normal multiple, which is a little discounted, I still have a very conservative but very high opportunity to make money. The analyst scorecard on Edison International is impeccable, which tells me that I probably have a better than average opportunity to trust the estimates that these analysts are giving here. I think that's really the key thing here. So moving on, next is Eversource Energy. Now, I like this one because it tells a real good story. Since 2013, the market has put a premium valuation. In fact, you can see that the normal multiple has been about 18. That's this blue line. This is a barometer, if you will. It's a valuation reference. So when you were buying this stock and look at this stock at its highest valuations here, even though there was really nothing going on with its earnings in terms of earnings growth was consistently staying around its 5 to 6% range. But the price got so high, and this is the lesson of valuation, that you ended up losing money owning this stock because valuations were so high. Now, notice in 2010, 2011, it was trading at attractive valuations. Going to the max level, you can see that a normal 15 times earnings, which is the orange line in this example, you can just point to it and it'll, what the PE is of the orange line, it's 15. You can see that's a fair value. That's an attractive valuation to buy this stock when it has a good yield. When you were looking at dividend yields, when the price was real high like this, the dividend yield has actually dropped to about 2.5%. Okay, and that's in contrast to the 5% or half the yield that you currently can get. And when the valuation has gotten low, like it is now, is when the yield gets up to over 5%. So it's just another indication of value and valuation. But my point is, this is a classic high valuation existed for 3 years here, if you will, until it started to really collapse over the next 3 years. Valuation matters, and it matters a lot. Evergy is another example that's almost identical. Again, we got 4% growth. We got a 4% dividend yield. Periods of high valuation are not the best times to be investing. Even if you stay with high valuation, or forget about the fact that it's corrected, you still only end up making about 3% a year. But you do get a decent amount of dividend income. Okay, that's the key. And again, this one's paying 4.3% dividend yield. It's very close to fair value here. If you're looking at it from a standpoint of the way the market has normally applied a slight premium in recent years, if we go to the normal multiple, we got a 15 PE here. If we go to the normal multiple, it's been about 18. This would give us a very attractive rate of return. But looking at a 15 multiple, which I think the stock is worth, it would be just, I would call this fully valued. It's just a tad overvalued. It was a better buy, obviously, when the price was below the orange line. But that still doesn't mean you can't make money. You can get a good dividend yield here and earn 7 or 8%, very similar to what you would do if you invested in fixed income or anything else that was primarily an income vehicle. The more income you're looking at, typically the less growth you're going to see. National Fuel Gas is a gas utility. It's had a surge in growth as gas is kind of emerging. If you look at this and use the tool, once again, to go backwards, this was a relatively slow grower, but the market put a premium valuation on it. But now that gas has begun to explode in use again, we're starting to see earnings of this grow again. We did have a couple of weak years that caused weakness in the price. Now earnings are beginning to advance and the price is advancing as well. We got a 3% dividend yield. The difference between here and the others is that you actually have a higher rate of return potential with this particular stock because of the stronger earnings growth expected over the next couple of years. We're actually looking at over 13% growth through the next, and actually it's 23% growth for this year and 18% for next year. So we're looking at something higher than even the 13% for the next couple of years. I find this one very attractive, and for disclosure, I am long this particular company for select clients that have their investment objectives fit an investment like this. The next one is New Jersey Resources, and once again, you see this very similar pattern with utilities. This is typically a faster growing utility, 6% growth, but you can see there is some cyclicality. Once again, you see the prices come in line with earnings. We've got almost a 4% dividend yield, and the opportunity here again is a very high quality utility that could generate a nice 7 or 8% rate of return over the next couple of years, maybe 6%, of which more than half of it is income. So of all the ones I've shown so far, this one might be the least opportunistic based on valuation and growth potential. Portland General, another one, we got this 5 or 6% growth rate over these last years. We see the stock has finally come into value. This valuation that we now see is what gives this the opportunity to give us a real attractive rate of return over the next couple of years if it trades at a 15 multiple. If it trades at a normal higher multiple, we got a chance to make really high rates of return and collect almost a 5% dividend yield while we're doing that. I think that makes this utility look very attractive going forward. And it is a high quality utility with moderate debt relative to how utilities normally go. And then here's the Suburban Propane. And I wanted to show this one because it's interesting in you can really see how earnings and the relationship between earnings and market price reacts. Now, statistically, it's trading at a PE of, we'll call it just under 11, which looks real attractive, a 9% earnings yield and almost a 7%, 6.79% dividend yield. But I want you to notice what effect earnings have had. As earnings have really been falling for all these years, the stock price followed suit and fell for all these years. You would have actually lost money owning this stock, even though it paid a dividend. As far as looking at the future, we're looking at a stock that's expected to grow very, very fast going forward, very similar to National Fuel Gas. It's another gas utility. But when you look at the analyst scorecard here, and that really relates to the fact that the company's earnings have been so bad and they've cut their dividend and so on, that how much can you really trust that? Well, this is where you really need to do your own due diligence and try to determine if these analysts are on track or not, and what you might think that they would be capable of doing. Going on, the next one is Spire. Spire is another quality utility stock, triple B plus. Again, growing about 4.5 or 5 or 6% growth. It depends on what time frame you're looking at, how much growth you're going to see. More recently, the growth rate has been a little lower. From a forecasting point of view, the stock is just a tad above my minimum threshold, or my ideal threshold, I should say. But it's not expensive, and it does offer decent rates of return going forward with a 4.65% dividend yield. So Spire could be one that could be attractive now. It's a better valuation than it's been in years, and I think that's the message that I'm trying to get across with this particular video. Next and last is UGI. This is another gas utility. We can see that the market had really been valuing it very high. The normal PE and the historical or fair value PE are almost identical here. This stock is a valuation story with a 5% dividend yield, forecasting for only about 2% growth, but with PE expansion and the 5% dividend yield, this could generate a very high rate of return. Looking at the normal multiple over more recent years, we get our 11.5 PE, and yet we still have an opportunity to generate a significantly high return. The point is, valuation here is what makes this attractive. The stock moving back into alignment with its fair value line, and then possibly even seeing it exceeded again like it did in the past. Okay, so this was a look at the 12 utilities that I came up with when I did my screen. And I think there are some good choices here for the income investor particularly. And there's also some good choices here for the capital gain investor or the total return investor, because of how cheap some of these stocks. All right, everybody, I hope you enjoyed that video on utility stocks. If you did, ring the bell, give me a like, subscribe to the channel, and take a look at subscribing to Fast Graphs. And one of the things I've done with these videos, these are real high-level videos, which means we didn't get into details on any of the stocks. But in the future, I'm going to be covering companies where I show how to utilize the Fast Graph research tool to make analyzing a stock fundamentally faster and fun. I look forward to showing you those videos in the future. Thanks for watching.